Welcome to Straight Talk and Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Erin Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement. You're live and local, St. Louis's favorite financial call-in show. I'm Erin Lapidus, president of JBL Financial Services, financial planner and wealth manager, and I'm joined this week and every single week by my dad, Jeff Lapidus, wealth manager and retirement coach, and my husband, Robert Markham, our life insurance and fixed annuity sales specialist.
Good morning.
Good morning, babe.
Good morning. We help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan with several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate.
Second is to provide an income stream they can rely on so they can do all the things they want in retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to couple with their Medicare coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, without Uncle Sam of the tax courts taking a big bite out of their money. And as their wealth managers, Erin, Rob, and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Good morning, gang.
Good morning.
Good morning.
Good morning, everybody out in Radio Land. Thanks so much for taking your time and tuning into our wonderful 2-hour show today. We have a lot of things on our mind. What's more important is what's on yours. We're live and local, so give us a call. 314-931-5877 or 84126 on the KTRS text line. And just as a reminder, there are lots of ways that you can keep in touch with us during the week.
That's right. Log on to our website, jblfinancial.com. You can click on the Contact Us button and request a coaching session, financial, Medicare, or both. You can also ask a question, and we'll try to get back to you. If it's during the show, we'll try to respond on the air. If not, we'll get back to you by email as quickly as possible. You can also click on the Sign Up button, and that will give you access to our Coach's Corner, which is our monthly newsletter. Rob keeps it up to date every single month, and it just so happens that today is the first day of November, my favorite month of the year.
As the kids like to say, the new mixtape has dropped. Our November 2025 newsletter is hot off the presses.
I mean, it's literally in your inbox as of just a mere 3 hours ago.
3 hours ago, it dropped.
It dropped.
All the kids are saying it, and I feel like one of the cool kids. I get to incorporate these young phrases. But we've got some great articles in the 2025 newsletter you're sure to enjoy. Our first one, traditional versus Roth. IRA preference differs by generation. By almost 2-to-1, Generation Z prefers Roth versus the traditional IRA option. Baby boomers are almost the exact opposite, 2-to-1 going the other way, traditional to Roth. And although the article doesn't say, it could be that boomers, being in their peak earning years, are enticed by taking the tax deduction now, as opposed to paying the taxes on the front end when they are most likely in their highest tax bracket. It also says for investors who expect to be in a higher tax bracket in retirement, a Roth may be a more beneficial option in the long run, but we're just not seeing that in retirement that you're in a higher tax bracket than when you were working. I know, Jeff, you wanted to comment on that.
Absolutely. And again, This is just something that we commonly see, which is why taking the deductions today, getting those tax breaks today, is more valuable than stuff in the future. And the truth is, we really don't know where tax rates are going to be.
That is true.
You'd like to think that with the national debt, they're going to be higher. That's what Erin was discussing earlier today with me. But not necessarily true.
I would just say that I think that we can be a little bit more nuanced, which is we often work with clients that maybe if you are hovering around a certain bracket, you take the deductions to bring you into the lower bracket, and then maybe you would like to build up some after-tax assets or some potentially tax-free assets down the road. And now employers are offering 401k Roth options, which they did not have in the past. Or if your income allows for Roth contributions, you want to, as they say, split the baby and take advantage of the tax deductions using your pre-tax account, and then also start to build some tax-free assets for down the line. Because the other thing that we see is, although many of our clients are part of the boomer generation, in fact, the majority of them are, the majority of their assets, except for our business owners, are generally split 90% in their retirement accounts and very little outside. So as we approach retirement, in a lot of cases, what we're working with clients before they retire is maybe we're pulling back on contributions, especially before Roths were available, Roth 401ks were available. We're pulling back on contributions to create more after-tax money. So if you had the opportunity to go all the way back in time to your first income earning years when you were in your lowest tax bracket, if you had stuffed a few dollars in after tax, maybe that would have been helpful fast forwarding 30 years later. So I think this is an interesting article. I just think that, as in all things, it doesn't touch on all of the nuances of making those contributions, which is why it's important to consult with, if you have an investment professional that you're working with, or everyone that has a 401k has an investment professional that they can work with. You just give them a call, and they're on the payroll every time you make a contribution.
Good thinking. Good advice.
And our next article, Balancing Life in the Sandwich Generation. The sandwich generation refers to middle-aged adults that are caring for their own children and their aging parents at the same time. This piece explores ways to achieve a balance between the two without losing your mind. And one that I'll touch on briefly is, if you have siblings or other family members willing to help, an all-hands-on-deck approach can help with this burden from falling on one person. Many hands in the pile can make a big difference. And our next article, Are You Prepared for the High Cost of Dying? You know, it's funny because I've talked about this kind of thing with my dad, and, my dad says, well, they can always dig me up. I always got a kick out of that. But in 2021, Americans spent $430 million on end-of-life hospice care. The average cost of a hospital care in the final month of life is more than $32,000. This article touches on the importance of planning, costs associated with end-of-life care, funeral arrangements, administrative details represent major and often overlooked expenses. By planning ahead, you can assure that financial hardship does not compound the death of a loved one. And our last article, beneficiary designations. Who gets the money? At the end of the year is a time when families often get together. This can be a great time to think about the future and make sure your beneficiary designations are correct and, most importantly, up to date.
So if you don't want to argue politics, you can let your children know that you cut them out of the will.
Maybe there was a passing of a loved one this year that impacts these designations. Maybe there was an addition to the family that you want to see included. Always important to make sure these designations are set properly, and most importantly, to review them constantly or consistently to make sure that as things change in your life, your documents reflect those changes. And I can just say, in most of our, if not all of our review meetings, it's one of the first things we ask, is this still how you want to see your documents reflected? Are these still your wishes? Just as a housekeeping operation, just to make sure that things are as they should be, because we know that things change in life. There's often additions. There can be, unfortunately, passing of loved ones, and we want to make sure that your documents are up to date. And that is your November 2025 newsletter.
I don't know. Rob's like doggy downer today. He's a downer today.
Right. The
All
high
these
cost
articles
of dying.
Uh-huh.
Who gets your cash when you die.
These are important. These are, I mean, unfortunately we have to talk about these things.
You know what else we have to talk about? People are chomping at the bit to chat with us this morning. We have 2 callers on deck, so let's go to our first caller, Sarah. It looks like you have a Social Security question this morning.
Hello.
Hi.
Good morning.
Good
Sarah.
morning.
Hi. I want to know well, I don't know how to explain it, but I still work, but I'm also getting Social Security, and I want to know if the taxes, am I going to have to pay taxes on my Social Security?
Sarah, if you don't mind us asking, how old are you?
66.
And did you begin your Social Security benefit at 66 when you reached your normal retirement age?
Yeah.
Okay.
I mean, not exactly at 66, but, like 8 months later, whatever it was.
Gotcha. And what's the income limitation on Social Security at 66? With the year you turn normal retirement age, Rob?
The year you turn your normal retirement age, they will take back $1 for every 3 that you earn over $62,160.
So are you currently earning over $62,000?
Yeah, but I was told that it didn't matter how much I made to collect my Social Security, because I'm at the point where it doesn't. Social Security itself told me that it doesn't matter how much I make.
Okay.
I won't have to pay taxes on my Social Security and at the time the bill hadn't passed, that the government passed where you don't pay taxes on your Social Security.
So
let me insert here. There's a little correction. The only way that you don't pay federal income taxes on your Social Security benefits is based if your income happens to fall below certain levels.
Right. So
Sarah, are you single or married?
Single.
Okay. So if your current income, plus half your Social Security benefits are less than $25,000 a year, then you would pay 0 income taxes on your Social Security benefits. Now, we do have the Trump bump this year, which is going to help you a little bit.
Right, which means
you get a $6,000 deduction.
You only get the $6,000 deduction if your income is below $75,000, though.
Okay.
So it does sound like moving forward, your Social Security is going to be taxable. However, you may receive a deduction from the big beautiful bill of an additional $6,000 if your income falls below that $75,000 limitation, because you also meet the other requirement of being over the age of 65. But your Social Security benefit is taxable. It looks like about at least 50% of it is going to be taxed at your current tax rate.
Right.
So because I make way over 73, but less than 100,000, so I'm going to get taxed.
So you'll have So it sounds like you'll have a partial deduction. You won't get the full $6,000, but you may get a partial deduction. But the Social Security itself is taxable above the line, and then you'll be able to use the deduction at the end to help potentially offset some of that. But that deduction is only available for 3 years. They may or may not extend it, but that was only a 3-year deduction incorporated into the big beautiful bill. It wasn't permanent.
Right, and also
so when I talked to Social Security, they asked me, and this was before the big beautiful bill passed or whatever it was called. They asked me if I wanted to take money out for my taxes, and then he went and said, "You don't have to because they're going to pass this bill."
Well,
So I should be taking taxes out of my Social Security.
I would
Yes.
I would certainly urge you to do that, because what happens is, because of your income level, 85% of your Social Security benefits will be subject to federal income tax, and so it isn't difficult to do that. And so withholding is a smart idea. Sometimes things get lost in the translation.
that's true.
And so I would suggest that Social Security benefits are always taxable. It's just if you happen to hit certain income levels, it's lower. So a single person, if your Social Security benefits, half of them plus your income is under $25,000, your Social Security benefits aren't subject to tax. If it's under $44,000, between 44 and 25,
50%
is subject to tax. And then if you're over 44, which obviously you are, then 85% of your benefit is subject to tax. So you've got 15% tax-free. You may even get a little Trump bump action for the next 3 years. Thanks for the call, and good luck to you.
Thank you.
You're welcome.
And it is easy to have taxes withheld from your Social Security benefit. You can log on to the ssa.gov website and log into your account, and you can do it online, or you can also download a paper form that you can fax into the Social Security office that just requests tax withholdings. So, and usually that change happens relatively quickly. So even for your very next check, you could have withholdings already in place. And if you get a little bit back from the Trump bump, then you'll just get a little bit back on your taxes, but then you'll have it all set in place for when that is over, and you go back to about 85% of your Social Security being taxable. That way you don't have to worry about any penalties or having a big bill when you get to April.
Yes, and I would tell everybody that it isn't difficult to do. I just went through this with electing my Social Security benefits and then going back after I'd received them and asked for federal income taxes withheld, obviously with the help of my daughter. It worked out good.
All right, why don't we get to our next caller? Good morning, Tricia.
Good morning. My question is, I inherited a 401k 2 years ago in November of 2023, and I heard you say in the past about converting it within 10 years, and I was wondering if that is 10 years from my assignment and receipt of it, or if it was when it was originated.
Oh, it's 10 years from the date of the individual's passing that you inherited the assets from.
Okay. And so that would be 10/2023 for me. That was my question. Thank you very much. That's all I needed to know.
Absolutely.
Well,
hey, that was a great one.
That was an easy one. We're just assuming that this wasn't a spouse, because then you're only subject to RMDs if they were getting them. You don't have to pick.
Right.
You're not subject to the 10-year rule because the code still permits that there are unlimited transfers during life and at death between spouses. Is when we get past the spouse with IRAs, that's where you're stuck, going to the new unfortunate 10-year rule, as we call it. So, good question. Thanks so much.
Okay, let's hit this one text really quickly.
And our texter writes, for individuals born in 1960 or later, the full retirement age is 67, meaning they can earn any amount with no benefits withheld.
So there's a little bit of confusion here. There is no take back for earnings if you elect your Social Security benefit after your full retirement age. So you don't have to worry about Social Security taking any of your Social Security back. However,
it will be taxed.
Right. This has no impact on the taxation of your Social Security benefits. So for individuals who are under their normal retirement age or full retirement age, electing Social Security, they have two things to compete with. The first is how much are they earning outside of their Social Security benefits. That will impact if Social Security deems that they need to pay some of their benefit back for the period between when they are under their full retirement age and when they reach it. And then secondarily, everyone who elects Social Security, be it spousal benefit, survivor benefit, or your own benefit has to contend with, is your benefit taxable? And that question is answered by an income calculation that my dad was doing briefly with our caller, Sarah. How much are you earning? What other income sources do you have? Plus half of your Social Security benefit will lead you to determine how much of your Social Security is taxable at your current tax rate. All right.
Very well put, babe.
And another text just came through, and texter writes, I'm getting my wife's Social Security now, retiring in December 31st of this year. Should I take taxes out in 2026? January will be zero income. I'm getting an IRA.
So I would say that you most likely, first what we need to do is determine how much you are withdrawing from your IRA account. So if you are rolling your 401k over into an IRA, that is not a taxable event. So maybe the texter means, they're going to create an IRA. There's no taxes in that movement from 401k to traditional IRA. However, when you begin to withdraw money from your IRA, that is going to be taxable, which means that gets added into that calculation. You're going to take every dollar that you are receiving from your IRA plus 50% of your Social Security benefit, because you're married, since you're receiving your wife's benefit.
So it's $32,000.
You're going to take, if that number equals $32,000 or more, at least 50% of your benefit is taxable. If that number exceeds 44,000, 44,000, then 85% of your benefit becomes taxable at your tax rate. So at minimum 15% of your Social Security benefit is tax-free. That's essentially all that we can say with the information that you've provided to us. So you may, based on this and based on what we just mentioned, consider withholding taxes from your Social Security benefit. We find that being consistent with all of your income makes sense. Most people throughout their working careers have taxes withheld from all of their wages. And if you're a 1099 employee, we always recommend that you're setting taxes aside to pay them later, or you're doing estimated tax withholdings so you don't run into the situation where you owe a large tax bill. But in retirement, you generally have more than one income source. You have Social Security, you may have pension, your spouse may still be working.
Could be rental property.
Could have some rental properties, but also you might be taking distributions from your retirement account. If you're withholding equally from all of the places that you can withhold and then making it a conscious decision to set aside taxes from maybe places that you cannot withhold, for example, if you're getting rental income, maybe you're setting money aside for that in a separate escrow tax account. That way you are always consistent. You're living off of your net income versus living off of a gross and then having to pay taxes later. If you have to withdraw money from your retirement account to pay taxes for the previous year, that's really changing how much you're living on every year, and it could be throwing off your income calculations. We're always looking at 4%. That's a gross number, 4% withdrawal, including taxes. If you disclude taxes and then re-include them later, you could be bumping your 4% up significantly more.
You're right, babe. And the other side is that if you under withhold, you have a tax penalty.
Isn't it 80% of what you should have paid needs to be done by December 31st?
Of the previous year.
Yeah.
That's correct. So when you're doing your estimates, and this happens with clients, the biggest hole that we see is that folks don't withhold money from their Social Security benefits because you actually have to do a separate form. It's not like they let you do it while you're applying, which would have been easy, but they don't do that. So
right. So nobody missed anything while you're applying. They literally don't have that option. It has to be done after you've applied.
And then what we try to do is generally we'll increase the withholdings we're doing for them from our sources to smooth this out so that they can deal with it. And then eventually, if they feel it necessary, and it really is, then go back to Social Security and say, hey, withhold taxes. You can do that at any time. There's not a limitation to do that. I would tell you, though, that your grandma, she refuses to do it. She'll say, well, if I do that, then I won't have the money.
But you really don't have the money.
Right, Grandma. So instead, what we're doing is we're sending you the money and paying your taxes so that you don't have the money.
Right.
Unfortunately, taxes sometimes make you a little irrational.
Well, that's also why, and for those of you that have listened to us in the past, when we're talking about our magic retirement numbers or when we're doing our calculation, we're always grossing up your income need to incorporate the expense of taxes. Because when we sit down with clients or potential clients and they say, I'm spending about $4,000 a month, for most of them, we know that they have not added taxes into that expense.
Right.
So we need to say, we're going to increase that to incorporate taxes, so that way when we send you a net amount of $4,000 a month, we have already determined how much taxes need to go to federal and state in order to get you that net number, but also can your portfolio support that? Because although you're not spending the money in terms of taxes, you have to pay it. So we need to make sure that that your portfolio supports that expense.
And it is, and certainly one nice thing that happens for us, for our clients, as well as for everybody else, if you want to, is that we do have the facility to withhold taxes and send them to the government for you.
Yep.
Don't do it on your own. I mean,
no need to make a part-time job of your taxes.
I mean, you force yourself into doing quarterly estimates if you don't permit your IRA, pension, whomever it is, to withhold taxes. So make it easy on yourself.
Right, and that's why if you withhold consistently throughout all of your income sources, you never have to worry about it. And this is a conversation we have literally every single day. We just had a couple join us yesterday. The wife is retiring or just retired a month ago, and her husband is continuing to work. And so we were having the conversation about where should we do the tax withholding from? And her husband said, I'll just call and increase my tax withholding. And I said, we can do that, but we planned that you're going to be retiring in maybe the next year or two. Why don't we just withhold taxes from your wife's Social Security because she decided to make that election? And then that way, her income is withheld just like it was while she was working. You weren't making up the difference with your withholding on your pay and then not withholding anything from her paycheck. Let's just withhold from her new paycheck of Social Security and also her IRA distributions. And then that way when you retire, we will do the same thing for you and it remains consistent. You don't get a surprise either in a tax bill or in a tax penalty. And also, you don't have to make taxes your part-time job. It just becomes a normal part of what you've already been doing.
Honey, all I would add to that is what it really, especially if you have a situation like you were just talking about where you have folks that are retiring at different times, it gives us an opportunity to really ask the question, how much of that income that you're receiving today are you saving? How much are you consuming? So that when the second spouse retires, we really can key in on what is the true spending number and their withdrawal rate. And that's it's great. I mean, we're not guessing. So it works out very well.
And with that, I think maybe we take our first break of the hour.
Let's do it.
And we're going to come back with some more of your calls and text, hopefully. So don't touch that dial. We're going to be back with more Straight Talk on Retirement right after these brief messages.
Hey, Heidi Glaus here, asking you to join us weekly as we present the KTRS Book Club, presented by the St. Louis County Library for readers of every generation. Books transport us anywhere our imagination wants to go. They are absolutely magical. The KTRS Book Club will introduce you to local and national authors, events, and special programs presented by the St. Louis County Library every week from 3 to 6 right here on the Big 550 KTRS.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at Erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
Some of my fondest memories as a kid is heading down to the hardware store. You had to pick up a couple of nails, a couple of screws, maybe a gallon of paint, whatever it may be, right? It was your friendly neighborhood hardware store. Well, those don't exist anymore in St. Louis, except for Schnarr's Hardware. They have two locations in Webster Groves and in Clayton Road in Ladue. Schnarr's Hardware is that place where you go in and you can get that bucket of paint, you can get a couple of screws. The advice is always free. And the one thing about Schnarr's Hardware that every single family hardware store used to have, and that is the smell. It smells like a hardware store. It's got the selection. I don't know how they do it. It's a small store, but they got everything you ever need. They got the paint. They got paint matching. They've got big green eggs. They've got screws and nails and everything a hardware store should have. Schnarr's Hardware. 2 locations, 1 great hardware store. Schnarr's Hardware. We'll see you there. Reese Nichols, the most trusted Missouri brokerage, is now proudly serving St. Louis. They're going to be celebrating with a ribbon cutting and a grand opening at their Chesterfield office on Wednesday, November 5th from 3 to 6. And the afternoon show, the Big 550 KTRS, will be there for the party. Reese Nichols is a Missouri-born company established 125 years ago and is proudly serving St. Louis buyers and St. Louis sellers with everything they need, including title and insurance to make your move seamless. To learn more, reesenichols.com.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Erin Lapidus.
Well, welcome back. It's 9:36 here on the Big 550 KTRS. We're Straight Talk on Retirement, and we're here to answer your questions and your calls. 314-931-5877 or 84126 from the text line. You know, up until several of the callers and actually the texters that we've had this morning, a bunch of questions about Social Security.
And we got more.
And which is cool. And I would recommend to everybody, you know, you get your 1040 packet, right?
I don't know if they still send those out.
Okay, well, in the packet is a worksheet.
Oh, yeah.
That you can do a Social Security calculation. So if you are if you are old enough, grown up enough, like some of us, where that calculation is important, whether it's to determine, hey, how much income should I pull from or how much should I work? Am I going to be subject to a take back? When won't I, etc.? That worksheet can be very helpful. But just remember, I mean, I have to tell you, I've seen one person in 20 years that isn't paying federal income taxes on a portion of their Social Security benefits. And they're not tax-free.
They're not tax-free except for if you fall into that very minimal category of the $25,000 or below. But we often have this conversation because many times you hear how to make your Social Security benefit tax-free. And we used to have this conversation frequently because sure, you could live off of, maybe you've built up a lot of savings, or you have a Roth that you've built some money up, and now you're going to take tax-free distributions from that. Granted, you meet the qualifications, or you're living off of savings, so you don't have, those assets were already taxed. That's only going to last for so long, most likely, and then you will be in the position where your benefits become taxable because for everyone that calculation holds, I believe it was it the Reagan administration that reintroduced taxes on Social Security benefits?
When?
Oh, I think he formalized it with the brackets. So you can also log on to SSA.gov to your My Social Security account or the .me account, and I believe that they also have calculators in there that are available to you to do those calculations as well.
Sounds good. And again, we're here to answer your calls and your texts at 314-931-5877 or 84126 from the text line.
Text line is very active today, and let's keep that Social Security theme going. Our next texter writes, you talked about federal taxes on your Social Security. What about state taxes?
Great news. If you live in Missouri or in Illinois, there are no state taxes on your Social Security benefits.
Woohoo!
That's pretty cool.
is it Missouri introduced that at the beginning of this past year.
Yes.
I believe it's been in place for Illinois for a while. So we just joined the party. If you live in Missouri, your Social Security benefit is not subject to state income tax. So that saved about 5% for most people.
There you go.
Very cool.
And our next texter writes, is there any reason not to roll over my employer 401k to an IRA after I retire? Thanks.
Yes.
If you are under 59 and a half would be the number one reason I can think of.
Yes. I mean, that truly is the only reason. Because then you'll want to access that money. You can do so. And we know that, as Rob has said many times in the past, once you take your money from a qualified retirement plan, 401k, 403, whatever it is, and you move it into a self-directed IRA, you fall under the IRA distribution rules, no longer under the 401k
and
or qualified plan distribution rules.
Why is there an extra benefit to those 401k distribution rules?
401ks are a accumulation vehicle, whereas IRAs are a distribution vehicle.
But in the instance of if you are between 55 and 59 and a half,
the 401ks have a rule of separation that allows you to take distributions from the 401k plans, so you can access that without the penalty, whereas the IRAs, once you move them over, as Jeff said, you're under the IRA rules, which don't allow for that.
Right, so if you are between the ages of 55 and under 59 and a half years old and you need money from your 401k to make your income work, your 401k will allow you to make distributions in any amount that you'd like without the 10% penalty. You will still pay taxes, but you're not subject to that early distribution rule. However, if you roll that money from your 401k into that self-directed IRA, you can still get money from it without the 10% penalty. However, you're going to be subject to what are called the 72T distribution rules, which are much more stringent in that they are a defined distribution schedule of, you get three options from the federal government. They essentially range a little bit less to a little bit more than 4% of the value of the account. It has to be, you have to elect one. You can make one change over a 5-year period, and it has to remain consistent either for 5 years or till you reach 59 and a half, whichever is later. So that means if you are under 54 years old, when you begin a 72T, you have to keep it going beyond the 5 years until you get to 59 and a half. It has to be exact for every single year, the same dollar amount that you agreed to. Or you pay the 10% penalty on everything you've taken from the day that you started. So in year 4, if you make the error, that means years 1 through 4, you have the 10% penalty for the distribution amounts. So that's why that loophole, the 55 and over rule, gives you some flexibility if you are retiring early, or maybe you're not retiring early. Maybe you are taking a part-time job and you still need some additional income. It's going to give you flexibility in order to make distributions if you need them.
And we've used the 55 rule a lot.
Yes, for our clients that are retiring, either we're making a decision to leave all or a portion of their 401k assets. Right. So they have not only the flexibility of income, but because those 72T rules require a specific amount of income and that income alone, it doesn't allow for unexpected events to occur and use that account to cover over those expenses. So it limits your liquidity. This is going to increase your liquidity options.
Very good.
And our next texter writes, Erin, we have $30,000 in our boys' 529 plan that probably won't be used for education. What can we do? What are our options?
That's a great amount of savings to have for education. I would say that we've got some new rules available to us, but you also have some old options, which would be 529s are very flexible in the sense that you can rename the account to other individuals. So if your boys have children, so maybe you have some grandchildren, you can say rename those 529s in the name of the grandchildren. or you can hold on to them in the anticipation of grandchildren, eventually saying that you would like that money to go to them in the form of education. The new rules allow you to, as long as the 529 has been in existence for 15 years, you can begin converting $529 into Roth dollars, but the beneficiary of the 529 has to be the owner of the Roth. So, for example, if you have two boys, they each have $15,000 in their 529. They can convert $7,000 into a Roth in their name per year, because that is the current Roth contribution limit, as long as those plans have been around for 15 years. So it would take about 2-3 years to convert all of it.
Well, who says you like the boys that much? I mean, you could change the name back to you.
That's true. You could change the name back to yourself, and you could convert to Roth for you. If you're over 50, you could do $8,000 a year instead of $7,000. But the name on the 529 needs to be the name of the Roth. So if you rename it in your own name, then you would be able to convert it to a Roth in your name. And that might make sense. And you might say, well, hey, we've got assets elsewhere that we might want to designate for the kids or the grandkids, and we want to turn this into Roth.
Well, sure, and it also doesn't mean that you also couldn't use it for you. I mean, truly, in terms of active learning, go and take some cooking classes in Paris, whatever it would be.
Or even at the cooking conservatory down the street, like
Amen.
Anywhere.
Etc. So, lots of options.
Yeah, and just because you've decided maybe you're reclaiming those dollars that you had identified for the kids doesn't mean that you can't designate dollars elsewhere if you feel that that's important. Like you saved that $30,000 for the boys, you want them to have it somewhere else, you can obviously do that too.
Pretty easy. So the current gift tax exclusion is $18,000 per person, so you easily could just make a new gift.
That's a good point too.
So think about that, honey.
Gifting to me, I always am thinking of you gifting.
No, it's better to give than to receive. So, gift.
You know what else is good?
Taking our next break.
Let's do it.
And we're going to get back with more of your texts, which are coming in fast and furious. We very much appreciate that. But for right now, we're going to take our second break of the hour, so don't touch that dial. We'll be back with more Straight Talk on Retirement right after these brief messages.
So you call your virtual insurance company to ask a simple question about your policy, but now you're on hold listening to this music while you wait and wait. Auto Owners works with local independent agents who tailor coverage to meet your needs and pick up the phone when you call, because you shouldn't be on hold so long that you memorize the music. That's simple human sense.
Ask First Mid Insurance in St. Peters if Auto Owners make sense for you.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
Hi, this is Dr. Dan Lang. Join me for Animal Talk every Sunday afternoon from 2 to 3 on the Big 550 KTRS, the Animal Talk of St. Louis.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Erin Lapidus.
Well, welcome back to our last segment of hour number one. Hour number two, the hour power, is coming up right after this last segment. Our messages, our phone lines are open. We'd love to hear from you, 314-931-5877 or 84126 from the Hot and Heavy Tax Line.
And our next texter has an RMD question. I turned 73 in April 2026. I understand I have to take an RMD out of my 401k or IRA starting on January 2026, let's say my portfolio goes down somewhere in the year of 2026 or 2027, will my RMD go down? Am I able to reinvest this RMD if I don't need all of it? Let's say I sell some property. Am I able to add that to my 401k? And if I do, does my RMD go up? Thank you. A lot of questions here.
The answer is welcome to Fantasy Island.
Well, let's take this almost one sentence at a time. But before we do that, Rob, tell us how is a required minimum distribution calculated?
They calculate it on the last day of the year of the previous year. So say you had to take an RMD in 2026, they would use the calculation of what was your account value on December 31st, 2025.
And then they apply the percentage based on your age.
Correct.
Of what you have to take.
And that is locked.
That is locked for the year. But because it gets recalculated every year in two ways, because December 31st of 26 account value is probably going to be different than December 31st of 25. And also, as your age goes up, the percentage that you are required to take is going to increase.
Incrementally.
Right, incrementally over time. I think by the time you get to 90, it's just shy of 10%. So from 73, it starts at just shy of 4, get up to about 10% when you get into your 90s. But the first sentence is, I understand I have to take my RMD from my 401k or IRA. Actually, this one is a little tricky. If you still have a true 401k, meaning you have not rolled your retirement plan assets from your employer into an IRA that is self-directed, you must take from both accounts. You cannot apply the amount that is required from one to the other. So this is the only type of account that has to stand alone. So let's just say, to be simple, if you have a 401k and you have to take $20,000 in a required minimum distribution, and you have 3 IRA accounts that total another $20,000 distribution, you must take 20 from the 401k, and then you must take 20 from one or all of the 3 IRAs that you have. You cannot take 40 from your 401k and have that 20 applied. This is the only situation in which that there is a difference there that you want to be careful of. Now, I love the idea, like, if your portfolio goes down mid-year, can I take less? But unfortunately, the number that they calculate on December 31st, like Rob said, is the number that you have to use for the full year. But in many cases, just like this past year, most people have seen appreciation in their 401.
It worked for them.
Exactly. So now the 4%, maybe if you started RMDs this year, you had to take just shy of 4%. That might be even less than just shy of 4%, because if your account value has risen over the year, or maybe, like in many cases, we've seen a lot of clients recoup what they've already taken out of their IRAs in RMD requirements. They've already seen that appreciation again.
You're welcome, Dad, if you're listening.
And the other thing is, it isn't unusual for our clients to ask us to withhold federal income taxes from those distributions, and then to reinvest those in a after-tax account, whether it's a trust account or a transfer on death account for them, so they can make some more money.
Right, because the real goal here is that the IRS wants their tax dollars. So extracting the money from the IRA, you don't have to spend it. You can redirect it into an after-tax account, be it a trust or a TOD account, and then have it reinvested the way that you would like. The 2 things that you cannot do with required minimum distributions are, you cannot put it into a Roth account. You have to take your required minimum distribution. It has to go into another account. It cannot go into a Roth. It can go into your bank account or another investment account that is after tax, not a Roth. And you cannot send it to a donor-advised fund. That doesn't count, unfortunately.
And as per his last question, let's say I sell some property and I add it to my 401k?
No.
You can only you can't add anything to a 401k unless it's through a payroll deduction, and you cannot add to traditional or Roth IRAs unless you have earned income. So
and it's considered a contribution.
Right, and it would be considered a contribution, which is fine. You are able to make contributions if you meet the requirements, and that would most likely alter your required minimum distribution for the next year, but it does not alter it for the current year. So you can think about it on January 1st, when you see what your requirement is, that's all that you have to take for the year, no matter what happens to the market or contributions down the line.
Good, very good, complex question, but the tax law is pretty simple. When you have to take money, you take it. You can only make contributions to eligible accounts with earned income.
Right.
Wages. You can't put other stuff in it. So good question. Thank you.
If he sells some property, he can always put that money in a brokerage account and get it invested if he'd like.
Yes, absolutely. Right. There are no limitations on after-tax account contributions.
Exactly.
And our next texter writes, I just retired at 68. Congratulations. I have a simple IRA.
Quit staring at me, Erin.
I have a simple IRA and a traditional IRA.
You're not already retired?
The trolling will continue.
Go to your room.
I have a simple IRA.
Rob's back to business.
And a traditional IRA. Is there any reason not to roll the simple into a traditional IRA?
The answer is no, there isn't a reason, as long as you're not contributing to that simple IRA ever again.
Right. If
simple isn't simple any. Really, simple is probably the least simple of IRAs.
Right. There are a lot of limitations on where you can move simple IRA assets and when you can do it. But the great thing about a simple IRA is that it was already an individually owned account. So if you decide not to combine it because you don't want to or don't need to, it has the same rules as a traditional IRA in the distribution, meaning you have to be over 59 and a half to make distributions from it. You can take as much or as little as you'd like after that point. Depending upon your custodian, it's relatively simple to extract money from your simple IRA account once you're no longer contributing to it. But it is also subject to required minimum distributions in the same way that a traditional IRA would be. If you like the investments in your simple and don't want to combine it with your IRA, even if you're completely retired, not contributing any longer, you don't have to. If you like the simplicity of one account, you can then combine them.
And you will save a custodian fee.
That's right. You'll save a custodial fee, or you'll be able to line everything up all in one place. You only know one required minimum distribution versus having to see a couple and adding those numbers together.
And truthfully, this is the same question that someone might have if they have a 403B.
Mm-hmm.
Same thing, right? Which 457, it's like, yeah, you can combine them into IRAs, and frankly, you probably should. Administratively, it's easier for you.
Sure.
There aren't necessarily any economies of scale, especially if you're working with an investment advisor that's using no transaction fee accounts. So it's all good.
Right. I guess if you're still purchasing A shares, then maybe you would have the benefit of break points.
There's O shares.
O shares?
Out of your mind for buying load shares.
But also, if you are at the same custodian, then even if you keep those two accounts separate and you are using A shares, you get the family aggregate. So just because it's in two separate accounts, but
it has to be in the same fund family.
It has to be in the same fund family, but it could be in two separate accounts to aggregate to get that break point. But those are kind of a thing of the past, I would feel.
Oh, sure.
And our next texter writes, how concerned are you with the government shutdown and the longer it goes on, it negatively affecting our investments and the wider economy?
I'm not. I'm just be honest with you. I mean, I certainly feel bad for those folks that are
losing
not
benefits.
Currently getting paychecks currently, even though we know that when the government comes back, they're going to get paid. So it isn't like their pay is gone permanently.
But they are.
It is an inconvenience for them.
Inconvenienced.
And certainly
people that are in need of benefits that aren't being paid.
Nobody should be inconvenienced, and we certainly feel for them. But how is this affecting the markets? Well, you can tell it's not. I mean,
and historically, it has not. And there have been, I believe, like 20 government shutdowns since the 80s.
And these are all short term. I mean, generally they don't go for more than, what is the longest one, 45 days or something?
I believe the longest was 29 days, and we're approaching that. But I would just say, actually, I don't want to say anything about this because we're not a political show, but we haven't seen this impact the market at this moment. and we haven't historically seen government shutdowns impact the market. So I would say it's something that for us to keep an eye on, but we're in the middle of earnings, headed into some more earnings in the upcoming week. And I always like to see when the market reacts to what we would call the fundamentals, which are what are companies' bottom lines and what are their projections for the upcoming year.
And you know what's even more fundamental?
What's that?
By not touching that dial, staying tuned for hour number 2 here of Straight Talk on Retirement with me, Jeff Lapidus, the retirement coach.
Erin Lapidus, the retirement coach.
And Robert Markham, your life insurance and fixed annuities sales specialist.
See you after the break.
Welcome to Straight Talk and Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Erin Lapidus.
Welcome back, everyone, to hour number 2 of Straight Talk on Retirement. As always, we're going to kick the second hour of our show off with our smart choices about your health care.
Because you care, we talk Medicare.
That's right. So if you have questions, because it is open enrollment.
And we know you have questions.
That's right. Give us a call, 314-931-5877, or send us a text, 84126 on the text line. Let's talk about what many people are thinking about.
Let's talk about the elephant in the room. We have been inundated since open enrollment started with basically our clients are saying, Rob, we got an email that our doctor was going out of network next year with Aetna. In fact, Aetna is telling us we can't use any BJC doctors. He went on to say we are losing all of our doctors. Do we need to change plans now? What will happen if they don't work something out by the end of the year?
So it's a great question. Many of you received letters, also emails, which were required to be sent out because Aetna and BJC have not yet reached an agreement. We are not on the inside of either of those organizations, so we can't speak to if they will. However,
we can say that we did see something very similar last year between Anthem and Mercy. This happens from time to time. Hospital systems and insurance companies need to renegotiate their contracts. Typically, they're able to come to an agreement before the end of the year. And in the case of Mercy and Anthem, they finally did make a deal towards the end of the year. Whether that gets resolved between Aetna and BJC is yet to be determined, but it would not be unusual if it went to the 11th hour.
Nope. And Aetna, they are currently in negotiations. Oftentimes when things become public, more pressure is put on both sides to reach an agreement. So the fact that those letters were released could work in everyone's favor. So why don't we talk about if you currently have Aetna and you use SSM, you don't have to worry because your physicians are still in network.
Correct.
But let's talk about for everyone else that's using Aetna, and maybe you have one or more physicians that are affiliated with BJC or with Washington University, which all contract together, essentially.
Well, the first thing you want to do is check your plan. If you have the Aetna HMO, you can change plans on or before December 7th. So now is the time to put eyes on those plans. And the new plan would start on January 1st.
Which means that would line up perfectly with BJC potentially leaving the market. You're going to have your BJC doctors through the end of the year. There is no fear of that. Then as of January 1st, you would be on a new plan.
If Aetna is still the best plan for you, you want to wait through the end of the year to see if they make that deal. After December 7th, you can still change plans from January 1st to March 31st.
So there is an alternative here. If you want to hold out and say, I like my Aetna policy, I really would prefer not to change. One, you can wait all the way until December 7th, make the change on that day if they still haven't come to an agreement on the negotiation yet. Or for everyone that is on Medicare Advantage, you have an additional opportunity from January 1st to March 31st, like Rob mentioned, to make a change to another Medicare Advantage plan. So if we get to January 1st, they still haven't reached an agreement yet, or they say they aren't reaching a good agreement this year, we're out of the network for 2026, you can make that change then. It's not ideal to wait that long. However, if you're someone that really happens to enjoy Aetna, then it does maybe make sense.
And, having that second bite of the apple in January, say they don't work this out, and you say, you know what, I just want to change plans to a United, Humana, Essence, or whoever makes the most sense. At that point, you certainly would have the opportunity to do so, and your new plan, assuming that you pick one in January, would start February 1st.
That's right. Also, if you waited till February, it would start March 1st. If you waited till March, it would start April 1st. March 31st is the last day that you can make a change. Now, before we get to our texts, because we do have a few that have built up, which is fantastic, many people are asking, why would you stay with a plan that doesn't include your doctors?
Well, there could be several reasons why. The main reason is that maybe the Aetna plan is still the best plan when it comes to your medications. For example, say you have specialized medications that only Aetna covers under their formulary, and the other insurance companies don't cover the medication, so clients will want to see if they make a deal so that their medicines are covered and they don't have to rely on another insurance company to improve their tier exceptions or tell them to take a new medicine.
Another example could be if you are someone that is in the middle of treatment and you are utilizing a large amount of radiology services. So maybe you're having multiple MRIs or spiral CTs a year. Aetna's copays for those services are substantially less than other companies, even going into 2026. You're looking at about a 50% discount using those Aetna policies versus using some other carriers. So it really does depend on what you're doing, who you're seeing, if making a change makes sense. We just took a look at a current client who actually received the notification that BJC was going to be out of the network. Turns out his physicians are contracted with more than one provider, meaning they not only have privileges with BJC hospitals, but they also had privileges at other hospitals. So his physicians are actually staying in the network. The issue didn't apply to him. So although networks change, insurance companies change benefits, not every benefit change and not every network change is going to have a direct impact on you. So what you do want to do is see where you're going to get the most bang for your buck, like we talked about. If the formulary still makes sense for you on Aetna, if the specific benefits still make sense for you on Aetna, then maybe that makes sense. Or we never talked about the final alternative, which is if you really like your Aetna policy, maybe there's a PPO version. Maybe you're on the HMO. Maybe you look at a PPO version of Aetna, because then you can still see BJC physicians. You're just going to pay the out-of-network prices as opposed to having to pay full price to see them.
That's an excellent point. And our first texter writes, I am in need of hearing aids. Currently, I have the Aetna Gold Advantage. Should I purchase the hearing aids this year or wait to 2026 with Aetna or a different policy? Which policy will give me the best benefits for hearing aids? Well, I would say that if you're on an Aetna Gold Advantage this year and you haven't taken advantage of the hearing benefit, you want to take advantage of that hearing benefit this year and get
Absolutely.
the most out of it, because that's
there's no reason to wait.
Right. There's no reason not to take advantage of the benefits that you're entitled to under this policy year. As far as next year,
I think Essence has a great benefit because they have that flex card where you can use it for anything, right?
They do. It's a $2,900 flex card that can be used towards dental, vision, or hearing.
So you get,
and you're not limited in in any category. You can split it up, or you can just use it all for one. So I thought that was a great one. Another great one would be the Anthem HMO. It does require referrals. Just want to put that out there.
And so does that Essence policy. It requires referrals too.
But there is a $3,000 hearing benefit. So.
But also Aetna, right, for this year, the Gold Advantage plan, as it is called now, next year it will be called Signature. That's $1,250 per year. And that's true of this year and of next year. Also, these benefits are renewable, which means use your benefit this year. Don't leave it on the table. You can, again, use it next year as well.
In essence, you're getting two benefits within the period of like 60 days.
Exactly. So never leave benefits on the table, especially when they are what is called renewable, which means you're having used it this year does not preclude you from using it in the future. So definitely take advantage.
And we have one comment, and the commenter says, the WashU ACA physicians webpage conveys new carrier for 2026 is United Healthcare.
So they are a provider. Washington University is contracted with United Healthcare. They're also contracted with other carriers, not just United. And also, I believe the ACA, that's separate from Medicare. So we've got a couple of things competing here, and that is not currently part of the negotiation that we're referring to.
And our next texter writes, I do not understand how the 2026 requirement for Aetna's Tier 3 deductible, which is $615, is going to work. Will I need to pay next year's Tier 3 deductible of $615 the first time I buy my Tier 3 drugs, or will I pay the 24% drug cost on each purchase, and will it take several purchases to reach $615 yearly deductible? Plus, when will we know what Tier 3 drugs cost will be? I am trying to determine my 2026 monthly drug cost. Thanks.
So the way the deductible works is if you have a Tier 3 med and you are using Aetna, you will pay the $615 the first time you fill your med if the medication costs more than $615. If it costs less, you will pay whatever the contracted rate of the retail value of the prescription is. So let's say it's $400. You're going to pay $400 your first fill. The second fill, you will pay $215. Then you will start to pay your 24%. And in that second fill, if $215 doesn't meet the $400, you're going to pay a portion of the balance to get you to what the correct cost is going to be. You do know the Tier 3 medication costs are available now. Rob, will you let us know on it? Just tell us the Signature HMO with Aetna, what Tier 3 costs. Oh, 24%. So if you log on to Medicare.gov or you log on to Aetna's website, you should be able to plug your medication in, and it will tell you what the 24% cost is, what your percentage cost will be to fill that particular medication. Unfortunately, we'd love to tell you the cost of your med, but we can't look them up right here in this moment. So, but you can log on to Medicare.gov or on to Aetna's website, and you should be able to see it. Or if you haven't received your booklet in the mail yet, it should be in the booklet as well. Should be able to tell you the pricing.
Absolutely.
Yeah.
And I think we've beaten down the techs into compliance.
Well, that's great. So please don't hesitate to continue to reach out to us, 314-931-5877 or 84126 from the text line. I know we've kind of focused on Aetna, but Rob, since you've been doing quite a few of these reviews lately, I know that you have started to notice things about the networks. So although Aetna might be changing the size of their network this upcoming year, what have you seen across the board with some of the other carriers?
United Healthcare has a very robust network this year, and it's very rare that I'm finding doctors that can't be fit into one of their plans in network. I just did a review just the other day. Woman saw more than a half dozen doctors and specialists, and they all fit in there. Even their allergy specialists, like the whole group was a part of it, which was really, really nice, because I know how important it is for people to maintain those relationships. They've had them for a good long time, and they obviously want to keep them. So, finding and fitting those physicians and specialists into a network that's going to keep them in the lowest cost environment is always a great thing. And another carrier that I would mention that's making a strong push this year with a very robust network would be Humana.
So carriers change rankings, so to speak, on an annual basis. Who has some of the better benefits, larger networks? They're all competing with one another, but the nice thing is they're competing for your business. So what we find is that there is always something for everyone. It's just a matter of finding the right fit. As we've talked about in the past with some of these benefits, I like to put things into perspective. So when we see clients that have lists of many physicians, like you just mentioned, 4, 5, 7 physicians, of course, we're going to do our best to fit each of those physicians into a network for you. But part of the reason that you come in to work with someone like Rob or like Frank is so you can have a longer conversation about how you are consuming your health care. Maybe we do find a network that fits all of those physicians. But if you put on your list every physician you've ever seen since the day you turned 65 until this past year, and maybe you haven't seen a couple of them in several years, or you had for example, maybe you had a knee replacement and you haven't had to go back to your orthopedic surgeon again since that knee replacement, things are going well, you still have them on the list. But if that physician is the one keeping you out of a different network, maybe we can let go of that physician for the year.
That's a great point. And, the individual nature of these choices, I mean, everyone has a different story. For last year, I saw a gang of people that dental was very important.
Sure.
This year, it seems to be that people want to make sure that all their doctors are in network, like you were saying. Other times it can be drug costs.
Sure.
It really depends on how you're consuming the health care and what in those variables is most important to you, and then we can work the equation backwards. As always, I like to, who are you seeing, what are you taking, and what is the lowest cost environment, and can we fit everyone in that network?
But then it's also important, who are you seeing, meaning who do you actually visit with? Exactly.
And like you said, if you have on your questionnaire, if you're listing every doctor you've ever seen in the last 5 years, but you haven't had a need to see an orthopedic surgeon for the last 3 years, maybe we're ranking them in, say, a hierarchy of importance. Like, sure. I see this guy twice a year, I see this woman 3 times a year, very important. Whereas, my orthopedic surgeon, I haven't had to see him, thank God, in over 3 years.
And I know we've sat in an appointment, or you've sat in on appointments, Rob, where people list their physicians because we ask that in advance, but then when you present the plan to them, they might say, hey, well, what if I don't care at all about the physician? What if I'll change my doctors to get the plan with what you perceive as the best benefit? So that happens as well. It's just important, I think, as I said, to keep a lot of these things in perspective. And then also, Rob, I think you put it well, ranking in importance the benefits that are of most priority to you, because then that way, also, if we find we're in a situation where all things are equal, all things aren't always equal. What's most important to you in terms of benefits, then we can narrow down what the best option is for you, because, like I said, there is something for everyone. And before we take our break for this, our first break of this hour, we've got one last text question on deck. That doesn't mean you have to stop texting if you have something in mind. So 84126 on the text line. But since you mentioned that Humana, could you tell us more about that Humana HMO?
I certainly can. Right off the bat, there's no added premium. So you're going to pay your Part B premiums, but there's no added cost to have this Medicare Advantage plan, so that's a plus.
Zero premium HMO. We like that.
There are also no referrals. Not that referrals are the big deal that they were 25 years ago. You're not going to physically have to, drag a piece of paper from one doctor's office to another. A lot of this most of it, if not all of it, is going to happen in the background. So, just want to put that out there. But there are no referrals with Humana. It also has a travel benefit, meaning you decide to go down to Florida, you take it on the hop to California, New York, wherever, and you're in need of some care, you can plug into Humana's network there and still get in-network pricing, which is great. Another great feature of this plan, it has an extremely low max out-of-pocket of only $2,700, which is, I believe, lowest.
One of the lowest.
If not the lowest.
Very cool.
It also has a very robust $4,000 dental benefit. So if that's something that's important to you, now obviously you have to see in-network dentists, but, as my wife said last week, say you have a dentist that's out of network, so you go and have all the preliminary work done in in-network facilities, and then have them send over those x-rays or your charts to the
real dentist.
Exactly. It's a way of soaking up some of those benefits that you're entitled to, while, it's almost like having your cake and eating it too. You will have to pay for out-of-network services with your primary dentist, but that doesn't mean we don't take advantage of the benefits that are already baked into the cake, so to speak.
Right. One last Aetna question. Will Aetna changes impact my Part B and Plan G coverage? My anniversary is in April, so no info forthcoming from Aetna right now. No. The nice thing, one of the advantages of those Plan G supplements is they do not use networks to base their coverage. Your network is Medicare. So as long as your physician accepts Medicare, they will accept you regardless of where you have purchased your Plan G supplement from. So when you are listening to network negotiations, they don't apply to you. If you are using a supplement, if you're using Medicare Advantage plans, then yes, those network conversations do apply to you. If you have Aetna in another form, meaning you have private coverage through your employer or individual health insurance, this particular negotiation may not apply to you, so you want to check with your provider and your either your employer, or call Aetna directly about your plan. Right now, we're only focused on what impacts to Medicare and their negotiations therein. So,
I just wanted to add one last thing about the Humana HMO. We had a texter that was very confused and a little bit dismayed about the $615 drug deductible. This also has a $615 drug deductible. However, only tiers 4 and 5 are subject to it.
So unlike Aetna, where they are putting tier 3 meds in the deductible category, Humana bumped that up to tier 4 and 5.
So that could be something for our texter to look into. Maybe Humana is offering a better benefit on the drug side. It's certainly
depends on the drugs you're taking.
Exactly. It's certainly worth exploring this year.
We agree. All right, with that, we are going to take our first break of the hour. So please don't touch that dial, but you're more than welcome to touch those cell phones. Give us a call, 314-931-5877, or send us a text, 84126 on the text line. We'll be right back.
I'm Farmer Dave, and here's my good friend and owner of MasterCars Inc., Alex Rosenberger, with today's hot MasterCars Inc. deals.
Thanks, Farmer Dave. As you know, we sell a lot of classic, luxury, and performance vehicles. Unfortunately, there's no factory for pre-owned ones. These are hard to source, so I'm always on the hunt. You have a pristine classic, collectible, or even interesting modern vehicle? If it has low miles and in perfect shape, I want to buy it. I love Corvettes, Porsches, Vipers, V-Series Cadillacs, and anything unique as long as it's in excellent condition. I'll do some great trading, too, if you're done with your current vehicle and ready for something new and exciting. We have very attractive financing options for just about any situation, too. Buying, selling, trading, just hop on our site, pick out your dream car, or submit your current dream car for us to buy.
So rev that motor and point your car in the direction of MasterCars Inc. and buy or sell today. 4100 Namioki Road in Granite City, or visit MasterCarsInc.com to get more details. That's MasterCarsInc.com.
Hey, it's Jill Farmer for Premier Heating and Cooling. St. Louis winters don't mess around, and neither should you. When those freezing temps hit, the last thing you want to do is discover your furnace isn't up to the job. That's why now is the perfect time to call Premier Heating and Cooling. Their certified technicians will give your system a full checkup, making sure it's safe, efficient, and ready to keep your family warm all season long. Think of it like an oil change for your car. A little preventative care now saves you from big, expensive breakdowns later. Plus, a tuned-up system runs more efficiently, which means lower energy bills when the cold really sets in. So don't wait until you're shivering under 3 blankets. Schedule your heating inspection today with Premier Heating and Cooling. Excellent rating with the Better Business Bureau. So many of their new customers are referred by happy customers like me. PremierHeatingCooling.net, 636-916-1122.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at Erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
If you're looking for your next home, think of First Community. Our Smart Choice Home Loan offers a 30-year fixed rate of just 6.531% APR to qualified borrowers, and you only need a down payment of 10%. Whether it's your first home, your forever home, or even a vacation home, be smart with a Smart Choice loan from First Community for all your savings and all your loans. Must qualify for membership. For terms and conditions, call toll-free 1-888-642-7969. Federally insured by NCUA. Equal housing lender.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Erin Lapidus.
Well, welcome back to the show. It's 10:32 here on the Big 550 KTRS, Talk Radio St. Louis. I'm Jeff Lapidus, the retirement coach.
I'm Erin Lapidus, the retirement coach.
And I'm Robert Markham, your life insurance and fixed annuity sales specialist.
And we are willing, waiting, and wanting to answer your questions at 314-931-5877 or 84126 from the text line. Really enjoyed that last Medicare segment you guys did. I mean, it's always fun, but it's interesting to get some insights. And, you know, I will say that, and this isn't bragging, but our parking lot is full. I mean,
like, full.
It is so fun to see us full. We're having folks coming in and out all day long in terms of Medicare reviews, as well as our coaching sessions we have with our investment advisory clients. Some are seeing me, going to see Rob. Seeing Erin, going to see Frank, etc. So it's great. We're really busy. We love it.
Not too busy to see you, though.
Exactly. So you can always give our office a call at 314-863-0008 or go to our website, hit the Contact Us section at jblfinancial.com. Cool.
All right, we've got a couple more texts on Jack.
Sure.
And our next texter writes, listening to you in Kansas City. Well, that's cool.
That is really cool. Thanks for listening.
And he writes, we are offered plans through Devoted. Any information?
So, St. Louis area also offers Devoted plans. However, they are just not yet competitive with the United Essence, Aetna, and Humana policies that we have been focusing on. I will say, though, that we contracted with Devoted last year, essentially because we want to have availability for all our clients across all of their options, and their service is very specialized. It's very personalized is another way to put it. I believe that they're on par with how Essence originally ran their business in that people are local. It's much smaller, so most likely you're going to get more personalized service from Devoted than you will from the national carriers. But what I like to say for individuals that utilize our office, if you're working with Rob or you're working with Frank, you get personalized service regardless of which insurance company you work with, because you don't have to listen. I mean, you don't have to call the insurance company. You call Frank or Rob, and they will help you navigate that as opposed to having to do it on your own. So if you're a person that would prefer to make these decisions on your own, I would definitely recommend taking a look at the Devoted policies, because they are going to give you more specialized attention, especially on the customer service side, and that can be very important for you.
And if not, we're Devoted, so it's all good.
I was just waiting for that.
We are Devoted. That's great.
Listening from Door County in Wisconsin.
Wow. I bet it's cold up there.
Probably colder than here. But wow, it's like national listenership. I love it.
Probably a Green Bay fan.
I mean,
let's not even go there.
Let's not. Last week was Go Pack Go.
Yeah, go the heck away. Okay.
Yes. All right. One last question on the Medicare side of things. Doesn't have to be.
Does Aetna currently have a PayFlex card for 2025? Will they offer one in 2026? No.
And no.
And no.
Yeah, so Aetna is not currently offering PayFlex cards now, nor will they be adding that to their benefit suite next year. However, Essence is going to be offering that.
A very robust one at $2,900. And as we said, that can be used in whichever category you'd like, whether vision, hearing, or dental. However, it cannot be used to make copays. This one
caveat
to all that I had to get clarification on, because my mind constantly
how do we maximize this?
How do we wring every last dollar? So I was just saying, well, what if someone doesn't want to use the PayFlex card for any one of those supplemental benefits? What if they just want to use it to pay copays? And I thought I was, no
way on the copay.
No.
No way on the copay. All right. So, but Aetna is still offering a host of benefits in terms of dental, vision, hearing, and over-the-counter benefits. So as we are seeing insurance companies having to make decisions about how to maximize benefits for their enrollees, the benefits are becoming nuanced amongst the carriers. How you access your dental, how to use the dental, what benefits are provided, what new bells and whistles are being offered. Again, this is a perfect reason why working with a professional is going to help you get the most out of your Medicare coverage, because they do know the nuances. So if you are working with someone, I would make it a priority to try to get on their schedule. If you're not working with someone, Frank and Rob has some time on his schedule still available.
Yeah, Frank is pretty much, it's
9 to 5 from October 1st through December 7th, really December 5th, because that's Friday.
We're having to stop back at the office to continue to work after the show. There's a good chance we're going to run into him there.
That's right.
And, the last point I'll make about folks this year, if you haven't maximized all your supplemental benefits, if you still have some over-the-counter benefit to use, if you still have some vision or dental,
eat some of that Halloween candy, head on to the dentist.
Because, it isn't you can take it with you into next year. These benefits run out on the policy at the policy year end. So, yes, you're going to get new benefits, but there's no point in letting what you're entitled to go by the wayside. So, as far as those supplemental benefits, you really want to scrutinize. Do you have anything left? Have you wrung the rag till every last drop has come out? Because you're entitled to it. You should get it. And
the insurance company isn't going to tell you didn't use it, and they're certainly not going to pay you out for it. if
exactly.
you don't.
So if you can still get in to see your dentist, if you have some dental benefit, if you have some over the counter, if you maybe you need a new pair of glasses, or you would just like a new pair of glasses and you have that benefit out there, please by all means take advantage of it.
If your wife says that you can't hear her, maybe it's time for those hearing aids.
Yep. They don't offer new wives under supplemental benefits, so deal with the hearing aids.
I was going to say, ladies, it doesn't correct selective hearing. So even if they do get the hearing aid, it might not help.
That's great. And again, our phone lines are
great.
open. We'd love to hear from you. 314-931-5877 or 84126 from the text line.
Do we want to take our second break well, why don't we... Do you have another text question maybe we could get to before we take our second break?
Well, that or we can get to one of our topics. We haven't gotten to one all day.
I know the text line has been just heating up. I just didn't want to break up one of our
Let's go a little longer.
Okay.
And our next texter writes, if I inherit a large sum of money from my parents, how is that money taxed?
This will let us go a little bit longer for sure.
Well, sure. So you have to think about inheritances based upon when you're looking at taxation. Are these IRA assets you're getting because your parents didn't pay taxes on those IRAs? You get the privilege of doing so in over a 10-year period. You're inheriting their required minimum distribution schedule if, in fact, they were old enough to take RMDs, or everything else except annuities. Those will step up to fair market value if you sell them after the date of death, which you obviously would be doing.
Everything else would be...
income tax-free.
Right, but everything else would include property, so the homes, if you sold a car...
right, real property or security.
Held outside of retirement accounts.
Right, annuities don't have that. Whatever your parents paid, that would be the basis. Any deferred interest that was in there, you would have to receive that. You could defer it up to 5 years. So, and
then also U.S. savings bonds, right?
Yes. So if you do have access that are in a taxable situation for you, it's really important. Don't do this on your own. Get with your advisor. Develop a strategy in terms of how to absorb, if you can, the taxes. Let's use a quick example. When we're talking about the 10-year rule, we're talking about really assets going from parents to other people, whether it's children, grandchildren, etc.
Or if you inherit from a cousin or an uncle or anyone else that's not your spouse.
Exactly. So what happens is that you inherit an IRA, whether it's Roth, and Roth is okay. You still have to pull it out over a 10-year period. But
no taxes.
But no taxes. And there's no requirement of distribution, so you could really wait all 10 years and then pull money out. But with a traditional IRA, you're subject to the 10-year rule, as we've discussed. You also have to inherit you are inheriting the RMD schedule of that person that you're inheriting it from.
So if they were over 7, if they were taking RMDs, you are now taking RMDs.
And if you're actively at work, which you probably are, if you're inheriting it from a parent or an uncle or somebody like that, our first question is, are you making the maximum contribution to your qualified retirement plan? And if the answer is no, well, guess what? You've got an easy way now. You're making a distribution.
Which is taxable.
You're going to your employer and say, hey, reduce my pay to increase my 401k or whatever would be contribution, hopefully to match that distribution, if not more. And you're really washing out the taxes.
Right. So let's say, using a quick math example, let's say that you had to take a $20,000 required minimum distribution from the IRA that you inherited, or you want to take $20,000 because you've got only 10 years to liquidate the account. You're already making some IRA contributions, so you want to increase. 401k contributions. So on a monthly basis, you want to increase your contributions by $1,000. So you would go to your employer and say, increase my contributions by $500 a paycheck or $1,000 a month, and then you could make that distribution of $12,000 from your from the inherited IRA, and that becomes tax neutral because you get to take the tax deduction for the $1,000 a month you put into the 401k. You're pulling $1,000 a month out of the beneficiary IRA, so your income doesn't change, nor will your taxes. You still have another $8,000 to take in this particular example I came up with, so we've got somewhere else to put it. Maybe you have a health savings account you could contribute more to, or maybe you're just taking it and paying the taxes.
Well, we know that the contribution limits, especially for someone at the age of 50, are certainly much higher. They can be up to, if they're like 62 to 65, they could be up to $31,000.
You could you could max even more out.
Right, you might be able to absorb as much. So things to think about, but getting together with somebody who's a professional to take a look at this, whether it's your CPA or financial advisor, is real important. And because, frankly, planning for taxes is better than paying taxes unnecessarily.
One more text.
And our texter writes, Blue Medical RX Plus PDP prescription drug plan will end December 31st, 2025. Are there others available area? There are.
There are many, many, many available in the area. So take this opportunity to, and most likely you've been mapped to another. Blue Medicare RX is, I believe, an Anthem-based prescription drug plan. They've probably mapped you to another one. Don't take their mapping as the gospel on the best option for you. They're just choosing what's most like the plan that they are discontinuing. You have the option to go outside of Anthem to see what other plans are available.
I mean, can you still go to Walgreens and go, these are my scripts, and then they'll run a program for you?
Yes, I believe Walgreens and CVS both offer that, and many Walgreens and CVS partner with individuals like Rob and Frank that sit in the locations. They're licensed agents. They'll let you know that they're licensed, and they can assist you. I do recommend working with a licensed agent in order to make this decision, because the prescription drug plan you elect before December 7th is the one you get for the entire year. There are no trapdoors, as I like to say. With the Medicare Advantage plans, you have another out, because starting January 1, you could make another selection through March 31st. But you have to be on Medicare Advantage in order to do that. They don't have a special election period outside of open enrollment for standalone prescription drug plans.
Sounds good. And with that, why don't we take our break number 2 of the hour?
Let's do it.
So don't touch that dial. We'll be back with more of your calls and texts right after these brief messages.
Recently, a good friend of mine was changing the light fixture in their kitchen, and they took the light fixture off the ceiling, and they looked inside the ceiling and said, what is the phone number to Michael Baldy? If they would have listened to me, they would have put Michael Baldy's phone number in their phone, because everybody needs a good electrician on speed dial. So here you go. The next time you need an electrician, you need to remember Michael Baldy and Baldy Electric. So the phone number, 314-968-9999. Indoor, outdoor, an old Victorian home, knob and tube wiring, and anything and everything in between. You see, Michael Baldy is a licensed electrician, and he has a team ready to go. Whether it's something for the ceiling in the kitchen, something for the lights for the holidays, whatever it may be, Michael Baldy and Baldy Electric. BaldyElectric.com, 314-968-9999, because everybody needs a good electrician on speed dial. BaldyElectric.com.
My perfect day has sand, salt water, and friends. But my moderate to severe plaque psoriasis can take me out of the moment. Now I'm all in with clearer skin thanks to Skyrizi. Risankizumab Riza, a prescription-only 150 milligram injection for adults who are candidates for systemic or phototherapy. With Skyrizi, most people saw 90% clearer skin, and many were even 100% plaque-free at 4 months. Skyrizi is just 4 doses a year after 2 starter doses.
Don't use if allergic to Skyrizi. Serious allergic reactions, increased infections, or lower ability to fight them may occur. Before treatment, get checked for infections and tuberculosis. Tell your doctor about any flu-like symptoms or vaccines.
Thanks to Skyrizi, there's nothing on my skin. And that means everything. Ask your doctor about Skyrizi, the #1 dermatologist-prescribed biologic in psoriasis. Visit Skyrizi.com or call 1-866-SKYRIZI to learn more.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at Erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
Vernon Weesey for AAA Home Services, a local family-owned American Standard heating and air conditioning platinum dealer that's been optimizing indoor air quality for 55 years. Temperatures are dropping. Now's a great time to have AAA service your furnace, replace the filter, and reset your humidifier. And if you need a new furnace, they'll give you a fair and honest estimate on American Standard, voted #1 by Consumer Reports. Call AAA Home Services at 636-397-3200. Online at AAASTL.com. Call AAA. We're on our way.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Erin Lapidus.
Well, welcome back to the show. We've got about 9 minutes left. Our phone lines are open. We'd love to hear from you, 314-931-5877 or 84126 from the hot and heavy text line we have today. It's great.
Basically, listener-driven show today. We love it.
Textorama. Let's go.
And our next texter writes, we are retired and recently sold a second home that was never used as a rental. We receive income from IRAs, Social Securities, and small pensions. Our income is under $100,000 a year. Can you tell me how we claim this sale on our taxes? Thank you for all your help. And by the way, Frank is great, isn't he?
Frank is great.
That's wonderful. Well, since the sale is a second home and not your primary residence, it's like any other security.
You have to pay taxes on the gains. So
right.
we're assuming...
You've held it longer than a year, long-term capital gains.
But also the other benefit is the sale price is not what you were paying taxes on. The sale price less what you paid for the house plus any improvements... Right. That number is what you will essentially add to your income and pay. Well, it's 15%, right, for long-term capital gains?
Yes, it can be. And again, we're also assuming that it never was a rental and you also weren't depreciating the property because those would have to be drawn back in. But
they said it was never a rental.
Okay, great. Well, that second home?
And you can't depreciate things that aren't rentals, right? So you can't depreciate your own personal...
No, you can't. Not your own residence. That's correct.
All right, so then it's just a long-term capital gain is what you'll pay taxes on.
Congratulations.
Yes.
Well done.
And our next texter writes, my previous financial advisor was very careless with my personal information and my identity wound up getting stolen. What safeguards do you have in place at JBL Financial to ensure that this doesn't happen to your clients? Excellent question.
Well, goodness.
We have guns.
Okay, this show will never get past compliance, so I hope everyone listened carefully.
Big guns.
We're required by law to keep our clients' personal information and personally identifiable information private. We're also considered liable if, through our office, your information is released. So we take that responsibility very seriously. Everyone that works in our office, including Frank, who is not securities licensed, is fingerprinted through FINRA and the SEC to ensure that he, background checked. So everyone that is working with us is also background checked and fingerprinted through those organizations. We also have specific requirements in terms of shredding documents that have personal information, having firewalls on all of our networks so that way your information is retained privately, and also when we send information, it has to be secure.
Yeah, and the final one would be, that's very good, honey, and the final one would be, we are not permitted to release your personal information without your approval.
Right. We cannot sell your email address. We can't sell your phone number or your date of birth. We can't even do that if you gave us permission to do so, which I don't know who would.
Well, as an example, and we do have to have written permission to send information to your account.
That's
as
right.
An example. So
we have to have special forms signed that give us permission to not only release personal information, but also account information on your behalf.
And then obviously, our broker-dealer, and I'm sure that the broker-dealer you previously did the same thing, is that when they send you your statements, your Social Security number only lasts 4 digits on it.
Right.
They're really good about protecting that information.
Right.
And the other thing is, you may not be aware of this, but we are required to take continuing education in regard to
security of your personal information
every single year.
Yes, that is true.
Which is good.
Another text, not a question, but great meeting with Frank last week. He said, "Call me Frankie." I just told him,
That's
Frankie Frisch. The Cardinals, great.
I thought he was going to say frankly.
When I first met Frankie, he introduced himself as Franklin, so it's very difficult for me to go from Franklin to Frankie, but I'm trying my best. I've managed to get to Frank, so. But I hope he's listening because he's up doing some work, so
now I'm
sure he'll appreciate it.
He's Frankie from now on.
I always call him Frank, and never Frankie, and I'm never a Robbie.
Yeah, I know. You won't even let me call you Robbie, as hard as I try.
My son-in-law, I don't know what I'm going to call you. So in either case, that's all good. Well, thank you so much for your comments. We appreciate it, and Frank does a very good job, as well as the rest of our staff, and we do appreciate those comments and feedback, right?
That's right. What else we got?
Next texter writes, what if retirement isn't my top priority? Do you help people with insurance or estate planning? Absolutely.
Absolutely, on the insurance piece of things, we can assist in estate planning, but we do not prepare documents, so we're not attorneys that would prepare your will, your trust, your durable power of attorney medical directive. However, we can be of assistance in helping you make those decisions. Right.
Well, it's really the fun part, and so I like to think that our job is to get you ready to see the lawyer.
That's right. You don't want to brainstorm on the clock, so... doing some brainstorming, some thoughts, some preparation before you go to see the attorney to help you not only guide you in terms of the legality of things, but maybe some things you hadn't thought of. But having a clear picture of what your goals are is always important when you're going in to see a specialist.
Almost like a dry run to keep that meeting as short and sweet as possible.
That's right.
Well, I think that it's important is, in all of these discussions on estate planning, we're usually providing our clients with a pretty good foundation of knowledge and information, and also feedback on what their thoughts and on their goals and objectives are. We want to put them in a position where when they go see the lawyer, that they're not at level 1, they're at level 2 or level 3, so they can have the discussions, ask questions, and have questions answered.
Right.
So they can get their documents done correctly, and that's and really that's what your will is. It's the final document that expresses your wishes.
Right.
Which is great.
And our last texter writes, when it comes to collecting Social Security, what is considered full retirement age?
Right now it's 67.
Right.
If you're born after 1960, 67 is full retirement age.
For this moment. Certainly that could change in the future. Interestingly enough, the way that they've seemed to have done it in the past is that they've kind of held on to 62.
right
as the early age, and they just keep expanding when your full retirement age is. So they're expanding the amount of time you can continue to work and get benefits, but again, they're also
not
putting on limitations.
And they're also not expanding that latest that you should take at 70 when those increases end. So 70 is really the cutoff when you should absolutely take your benefit because you're not going to see any additional increases. So they're, like you said, Dad, they're just expanding the time that you can work. Shocking.
Yay. And when you talk about maximizing your time, if you're within 5 years of retirement or you're already retired, you know what to do. Pick up the phone. Give us a call at 314-863-0008 for a free coaching session. Thanks so much, and we'll see you all next week here. It's at 9 o'clock on the Big 550 KTRS.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Be listening next week at 9 for more Straight Talk on Retirement with your retirement coaches, Jeff and Erin Lapidus, on the Big 550 KTRS.